Hello and welcome to students from groups 8 and 18 in Accounting 1 at Swinburne Uni, teaching period 3. That was a mouthful. Hi, hope you've enjoyed week 4 and we've finished now our second week of looking at financial position and then financial performance. Sorry, we've just done financial performance, haven't we? Now, I hope you've enjoyed that. We'll be going forward into week 5 to look at cash flows, as you may well be aware. Cash flows the cash flow statement looks at the difference between profit and loss in an accrual sense and compared to the cash in and the cash out. Now, we've spoken about accruals at a little bit of length in the past, and so now we're looking at the other side of that coin to see basically where the cash is going in and out. Now, this is important. Why? Well, as they say on Wall Street, maybe, I don't know, never been there, cash is king. Cash is king. And when you look at getting a loan or really assessing a business's viability, one of the key things to look at is cash. And banks look at cash mainly because they don't accept accrual payments, they accept cash payments. They don't accept book entries, they accept $100 notes or bank transfers, and that's it in terms of repaying that loan. And so you could have all sorts of assets and accrued revenue, but unless it's actually in your bank account, you haven't landed that yet. So that's why the cash flow statement is so important. Cash is king. And in any sort of operations, it will be an important component of planning of when the cash will come in and when it will go out, the timing of it, to work out what sort of working capital you need. So you may need some sort of float to actually run that operation, and there's a cost to having working capital. So all that has to be taken into a consideration. And it is also the cash flow statement, one of the mandatory statements in the financials of a company. So we'll be going into that in quite a bit of detail. Now, there's also a cash flow simulation game. I encourage you all to get into that and really just sort of get a practical example of how it works. And I think that's absolutely paramount in our studies and in our courses and things, that we actually do get some practical insight into how this works in real life. So definitely have a crack at that. I think it'll be a great use of your study time. Speaking of which, Glenn has brought up a fantastic question, and that is around budgeting and how does budgeting fit into what we've been doing so far. Now, of course, a statement of financial position is a position at one point in time, also known as the balance sheet. That is generally the annual statement of financial position is as at 30 June of any particular year. Some companies can change their financial year, but typically it's from the 1st of July 2014, for example, to the 30th of June 2015, which is our current financial year. So we're looking at a point in time for the statement of financial position. The statement of financial performance, on the other hand, is looking at a time period. So it would be looking at everything that's happened between the 1st of July to the 30th of June 2015. So that's the difference between those two statements. And balance sheets, of course, can be done and updated any time throughout the year to actually give you an accurate representation of the business's wealth at that point in time. Now, budgets, on the other hand, look forward. Budgets are a period of time, cover a period of time, but they look forward. Now, they are not a part of the financial statements. Why? Because they are internal. Businesses set up budgets internally to manage their cash flow, to manage their expenditure and their resources. So they can set up both revenue budgets and expenditure budgets and capital expenditure budgets. And they set up all of these things, and sometimes into quite elaborate systems, that actually sit alongside the ledger. So a budget entry will go in at the start of the year to reflect what they think is going to happen. They might budget $100,000 to spend on computers, and then throughout the year, as they spend that and they make transactions in the ledger and they spend, $1,000 after $1,000 after $1,000, it adds up, and at any one point in time they can say how they're tracking to their budget, and the budget will have phasings throughout the year, so that in 1 month they're going to spend $10,000, next month they're going to spend $12,000, so on and so forth. You get the idea. Glenn, your specific question is a very interesting one, and I think you've hit the nail on the head by saying that you could do a percentage reliability for those players who come in and drop out. You could sort of do a bit of a forecast, and you could look at the history and make an estimate of how many players are going to drop out. I guess the difficult thing is it's never going to be 100% reliable. So some years you might find that no one drops out, and so you wouldn't want to oversubscribe the team and then have to ring someone up and say, sorry, I told you you had a place, but you don't have one. So I guess the thing is with forecasts, which what I was just describing and what you've described in your email is a method of forecasting, which is different to budgeting in the sense that a budget is done at the start of the year, and then throughout the year you do a forecast which basically says, this is how I think we're tracking to budget, and this is how I think we'll be at the end of the year. That forecast, based on your reliability figure, is never going to be exactly on. So that's the thing about forecasts. They're very handy, they're very important, and they allow us to allocate resources most effectively. But you've always got to have a way of adapting if the forecast turns out to be wrong. So if all of the players stay on, I guess you've got to have a spot for each of them in a team.